In today's episode, we are exploring passive investment options to grow your wealth with minimal ongoing effort. Passive investment involves putting your money into strategies or assets that generate income or appreciate in value over time without requiring significant active involvement from you. Our focus will be on defining each option in detail, talk about a few examples about how this could work, and talk about a few mistakes you should also avoid. Now, if you're ready to unlock new financial opportunities in 2025, let's dive in. The first one we're going to be talking about is real estate. Rental income. Real estate rental income involves, purchasing a property to lease to tenants, whether this is residential or commercial. This strategy provides a steady stream of monthly earnings as tenants pay rent, while the property value also appreciates over time. For busy professionals, I would suggest hiring a property manager because that can streamline your operations and then making rental income a relatively passive investment option for you. Also, within the real estate space, there's also real estate crowdfunding. Now, real estate crowdfunding enables individuals to pool their money together to invest in large-scale real estate projects like apartments and complexes, office buildings, commercial spaces. Unlike buying property outright, this method allows investors to participate with much smaller contribution. Returns typically come from rental income and property appreciation, offering an accessible entry point into real estate for low-income earners. Now, for example, you could research online for platforms that allow investors to participate in crowd-funded real estate and earn quarterly dividends from rental income. But it's very important to do your research, okay? A lack of research could lead to poor returns or even loss of capital.
Hey, before we go on to the next point, have you clicked on the subscribe button? Please click on the subscribe button, like the video, it helps with the YouTube algorithm.
The second, dividends paying stocks. Now, what are dividends paying stocks? Dividends paying stocks are shares of companies that regularly, distribute a portion of their profits to shareholders in form of dividends. These companies are often, well established with steady earnings that make reliable and consistent payouts. The strategy combines the benefit of stocks value appreciation and a steady income stream. Examples could be investing in blue chip companies that you have monitored their performance over a period of time and ensures regular dividend income alongside long-term stock growth. I think one of the mistakes to avoid here is just remember that high dividend yields could sometimes indicate financial instability for a company. So always investigate the business fundamentals before investing. Next, peer-to-peer lending, or just call it P2P. Peer-to-peer lending platforms connect individual investors with borrowers, enabling you to lend money in exchange for interest payments. It's a way to bypass traditional banks and earn, competitive returns. P2P loans often come in varying risk profiles, from personal loans to small business financing. There are various platforms that can help with this, and you could lend to vetted individuals or businesses and also earn interest on these contributions. So do your research online for platforms like this. However, one mistake to avoid is investing heavily in high-risk borrowers, okay? Because this could lead to loan defaults. So it's important to diversify your lending across multiple borrowers to spread your risk. Next, high-yield savings account and fixed deposits. They often offer higher interest rates compared to your standard accounts. These are low effort investment vehicles suitable for very risk-averse individuals. Fixed deposits in particular lock your money down for a fixed term, while high-yielding savings accounts often offer you a bit more liquidity. You could ask your bank to provide you with competitive rates for savings and fixed deposits, allowing your money grow securely. Next, real estate investment trust, or REITs, like many people call it. A REIT is a company that owns, operates, or finances income generating real estate. By investing in one of them, you gain exposure to real estate markets without the hassle of managing the property yourself. REITs often pay out the majority of their earnings as dividends, making them, a popular choice for passive income. There are different types of REITs that generate income for senior housing and medical facilities. It's important to do your research and ensure that the REITs with high debt levels, you avoid them, or lack of property diversification, as this can pose financial risk to you. And here's the bonus one, guys: index funds or ETFs. Index funds and exchange traded funds, which is what we call ETFs. They put investor money to track the performance of a specific market index, like the S&P 500. These are low-cost, diversified investments that reduce the risk associated with individual stock picking. For example, the Vanguard S&P 500 ETF allows individuals to benefit from the growth of top 500 US companies without managing individual stock. I think timing is important with this market. Overreacting to short-term fluctuations can undermine your returns. Patience and consistency are key to maximizing this strategy for passive income investment. Hey, in conclusion, investing passively is a proven way to build wealth while maintaining focus on your 9-to-5 career. From real estate to index funds, these strategies offer diverse opportunities to grow your income without heavy involvement. However, every investment comes with risk, so research and due diligence are your best allies. Remember, financial growth starts and ends with informed decisions. See you at the next episode of 9 to 5 and Thriving.